Welcome, everybody. It's good to have you all with us. Thank you for taking the time out of your day to join us today. This is Nathan Lee with Richie Mae. I always look forward to these quarterly trend series webinars. It's a great opportunity to get some insights from some of the folks here at the firm that are in the trenches working with clients, and they share some of those insights and the recent learnings and the things that are going on out in the industry as we speak. And as we know, there's a lot going on out there right now, and it's been a challenging year. I think as we approach December here and nearing the end of the year, it's probably one that everybody will be happy to put behind them and turn the calendar page over to 2024 and hope for a little bit better year next year. Fortunately, I think there is maybe a little bit of hope that maybe even just a month or two ago seemed like was a little bit farther off than it may be. And, you know, given inflation data and other economic indicators, that there might be some reason for hope that the sun's coming up here after probably a challenging winter for a few months. But hopefully when we get to spring, things will pick up. And we'll keep the fingers crossed anyways. I know you all are doing the same thing, but thanks again for taking some time out of your day to be with us, and we hope that what we share with you today will be valuable and be insightful, and that you'll be able to take away a few things that'll be helpful to you in your businesses. Just a couple housekeeping items. Everyone has been placed on mute, but you can come off of mute when we get to the end of the presentation today. We'll have some time for Q&A. You can come off mute and ask your question if you'd like, or you can drop your questions into the webinar chat function and we'll get those. And at the end of the webinar today, we'll take some time to respond to those questions. Also, as a reminder, this is a CPE credit eligible webinar, and in order to get CPE credit, there will be 4 poll questions, and you'll have to answer all 4 of those poll questions. So pay attention, make sure that you're staying alert, looking for those poll questions when they come, and get those answered so that you can get your CPE credit. The webinar will also be recorded, and we'll share the recording and slide deck out to everybody within the next few days. So keep an eye out for that as well. So now, just by way of background, for those of you that may not be aware, I think most of you probably are, but Richie Mae has been involved in the mortgage industry for many years. Firm was founded almost 40 years ago, has been in the mortgage industry for probably 35 or so of those years, and we have the pleasure of working with many companies around the country, and we really enjoy the work that we do. We enjoy each of those client relationships, and through that work that we do, we gain a lot of insights. We have experts across a variety of fields here at the firm, across audit, tax, and cybersecurity, and data analytics, and compliance, and so on. And those insights that our team members glean as they work with clients, we try to leverage those and bring value to our clients. And we'll be using some of those insights and learnings here today as we share today's presentation with you. So with that, we'll just briefly touch on the agenda, and then I want to introduce our presenters today. But we'll, as we do in all of our quarterly trend series webinars, we start out with a presentation of the most recent quarterly data that we gather from our Richie Mae Select peer benchmarking program. And so we'll share some of the trends that we saw in the third quarter. We'll share some year-to-date information and some quarterly information. And then we'll hand it to Seth, who'll cover some servicing topics for us and dive into whether servicing is a good thing or a bad thing right now. And I'm sure there are a lot of opinions on that topic, and Seth certainly has some. He'll share some of that with you today. And then we'll dive into some learnings, takeaways, things that Fannie is paying attention to and focused on as part of their MORA reviews, just to make sure that clients are aware of and prepared for those, because there has been a significant number of those reviews taking place. Fannie has been very active, so we'll share some of those thoughts with you. So with that, I'll just briefly introduce the presenters today, along with a thanks to each of them for the time they spent preparing for this today. So we'll first be hearing from Molly Manuzak, who leads our data analytics and benchmarking practice here at the firm, and she'll share the quarterly trend data with us. And then we'll hear from Seth Sprague, who most of you probably already know, doesn't need much of an introduction, but Seth is well known and highly regarded in the industry on a lot of topics, including servicing, which he'll talk about today. And then we'll conclude with Mignon Davis, who leads our compliance services practice, and she is very active working with clients on all things related to risk and compliance, and dealing frequently with findings from Fannie MORA reviews and helping clients around a number of compliance areas. So with that, again, thank each of our presenters. Thank all of you for joining us today, and we'll hand it over to Molly.
Great. Thank you so much, Nathan. So I'll go ahead and dive in. As Nathan mentioned, my team is responsible for multiple analytic and benchmarking offerings at the firm, which includes Richie May Select, which is what I'm going to focus on today. So Richie May Select is a quarterly financial benchmarking program. We started Richie May Select back in 2012, so just over a decade ago. So each quarter, our participants submit their financials, and then they're able to see that in comparison to their peers. We have about 75 IMBs participating. Peer groups are broken out by size and channel mix. And today I'm going to be reviewing origination trends and then key financial metrics that we saw in Q3 of this year. So in Q3, we did see an overall decrease in production. We also saw a decrease in both net production income and GAAP net income, and I'll get into the differences in those two metrics. However, secondary gain on sale was up in Q3. And then lastly, we did see an increase in overall cost to originate on a per loan basis. So again, we're looking at results from Q3, which were released earlier this month. We'll be looking at trends for the entire Select population. So just keep in mind that we do have companies of all shapes, channels, sizes, etc. So really we want to be focusing on the movement in averages over time. And then I will also be breaking out some key differentiators that we saw in top performers, and then look at some recent trends with our peer benchmarking that we have in our Analyze product. So before I dive into origination trends, we're going to do a quick poll question. As Nathan mentioned, you do need to answer all 4 questions if you want to get that CPE credit today. So the question is, what is your expectation of your mortgage originations in Q4 compared to Q3 of this year? So up between 0 and 10%, flat to Q3, down 0 to 10%, other, or I don't originate. So we'll give everybody a little bit of time to answer that.
Molly, votes are almost in. We have about 85%, so we'll just hold on to make sure that those who want CPE credit can get it. About 10 more seconds left that we'll have the poll open, everyone. So please, if you'd like CPE credit, please answer. Okay, Molly.
Okay, that's great feedback. And it looks like kind of the answer is most people are seeing originations down 0 to 10%, followed by I don't originate. So again, that's great feedback. That is similar to what we're seeing currently in Q4, and I'll go over that in a little bit as well. So now I'm going to go ahead and dive into origination trends from Q3. And again, this is released from Richie May Select. So here we're looking at average production over time, going back to early 2018. In Q3, production was down about 7% on average from Q2 of this year. If you recall in Q2, we did see a pretty substantial production increase, but again, Q3 ended slightly behind on average for participants. This was certainly expected given the increase that we saw in rates throughout Q3. And if we compare Q3 of this year to Q3 of last year, production volume is down about 32% over that time period. And then breaking production out into purchase versus refi, purchase production as a percentage of overall production is about the same that we saw in Q2 at about 91% of total volume. To give a bit of context there, prior to 2022, purchase production was typically around 65% of overall production. And then we saw that increase steadily throughout 2022. And then we've seen roughly the same mix of purchase versus refi throughout this year, again, with purchase being around 90 or 91% of overall production. So again, these are Q3 numbers, which were released earlier this month, but given that it's the end of November, we're a couple months into this quarter, so I wanted to dive a little bit more into more recent trends, which we can do through our peer benchmarking from Analyze. PeerView Ops allows our clients on Analyze to see their production and operations metrics in real time against their peers. And we're able to pull that data nightly. So I can see current Q4 results compared to the same point in Q3 to really see where we're trending. So funded production, we're seeing funded production down a bit more than that 0 to 10%. We're seeing it down nearly 30% quarter to date on average in terms of volume, about the same in terms of units. And then we're also seeing similar trends when we look at apps and locks to get a better idea of, where that production might move for the rest of the quarter. So again, apps are down about 28% and locks are down about 30%. So about 30% across the board. And then again, given where rates have trended this quarter, and it is typically a slower quarter for production, these numbers certainly aren't surprising, but as Nathan alluded to, we've seen some recent improvements, so there's definitely some hope that there will be a little bit of pickup, and hopefully at least going into 2024. So next, I'm going to move into some of the financial trends that we saw in Q3. So here we're looking at net income compared to net production income. Net income, this is really what you would compare to your audited income statement or that GAAP income. And then net production income is really intended to show origination platform profitability. And I'll dive into how that's different when I go into that metric. So this quarter, we did see a decrease in both net income and NPI. Again, Q3 did offset the improvements that we saw in Q2. Looking at net income, that did decrease on average, leading to an overall net loss in Q3. And you can see net income on your screen by that blue line. Net income was down about 36 basis points on average compared to Q2, and that overall net income was negative 31.4 basis points. In Q2, we did see about half of participants had an overall positive net income, but that did decrease to about a third of participants in Q3. The decrease was mainly driven by, of course, a decrease in production, but then increases in overall expenses. Most notably, we saw that salaries, commissions, and benefits increased this quarter. That line item typically makes up about 70 to 80% of overall expenses. So an increase there, even though it was only about 5%, did have a material impact on expenses. In Q3, we did see a slight increase in revenue, but that was offset by the larger increases that we saw in expenses, again, leading to overall negative net income. So similar to last quarter, I wanted to kind of dive into, what we're seeing when we look at top performers compared to the rest of the population of participants. For top performers, we looked at the top 20% in terms of GAAP net income. So again, they all had positive net income for Q3 when the overall population had a net loss in Q3. So the top performers did show notably higher gain on sale and net servicing fees, which led to a difference of about 90 basis points, which is pretty large when comparing the top performer population to the rest of participants when looking at that overall gross revenue for Q3. So pretty significant difference there. And then top performers also had lower expenses nearly across all categories, but particularly in that salaries, commissions, and benefits line item, expenses were lower only by about 12 basis points, but still a notable difference there. And so these factors together push net income for top performers well above the average for overall net income that we saw for Q3, which again was a net loss. So now we'll look at net production income. If you're not familiar with this report, what we're trying to do is show origination platform profitability. So we're excluding a number of items from that GAAP net income to get an apples to apples comparison. So we're taking out anything not related to production, for example, servicing or any outside activity and investments. And then we're also minimizing noise by removing unrealized gains and losses, i.e. unrealized gains from your unfunded lock pipeline, and then removing any loan loss reserves. So net production income, which is the green bar on your screen, we did see another decrease in Q3 of net production profitability. In Q2, we did see an improvement in that number, but then that was offset this past quarter. So NPI decreased only by about 5 basis points on average, so not as big of a shift as we saw for net income. And net production income was down to negative 42.6 basis points in Q3, again, on average for participants. So similar to net income, that decrease was largely driven by overall production decreases. And then similarly, we saw an increase in overall production revenue, but that was offset by a larger increase in costs to originate. So within production revenue, we did see an improvement in both secondary gain on sale and in origination fees. Another thing to note in Q3, that net warehouse spread that we talked about last quarter was negative again, which this isn't typically a large contributor to overall revenue, but historically it has been positive, and this is the second quarter in a row we've seen that number negative, which just further demonstrates, the challenges that lenders continue to face this year. And then on the expense side, we did see overall increases in nearly every expense category, but the highest increase was in overall operational expenses, which were up 13% in Q3 compared to Q2. And these factors led to an overall net loss on production profitability in Q3. So if we look at the top performers again and compare that to the rest of participants, we saw very similar trends. Again, we're looking at the same population of top performers here. So lenders whose overall profitability was in the top 20%. So again, we saw increased revenue and decreased expenses with top performers compared to other participants. On the revenue side, production revenue was up, mainly due to higher gain on sale margins seen for top performers. And then on the expense side, expenses were lower by close to 40 basis points compared to the rest of the group. And most of that came from the operational side and only a little bit of change in the personnel side. So again, all participants on average saw an overall net loss on production profitability in Q3, but the top performers did show an overall gain in net production income. So if we dive a little bit more into that secondary gain on sale number, here we're looking at the secondary gain on sale number from our NPI report. So we're showing realized gains and losses here. This does play a large role in that overall net production income number. And again, this is an average of all participants. So secondary gain on sale was up slightly in Q3, only about 2% or 6 basis points when comparing to Q2. In Q3, secondary gain on sale was 265 basis points on average. Although we did see a moderate increase in Q3, secondary gain on sale does remain near program lows, although slightly above. The historical low that we saw was in Q3 of last year. So the increase in secondary gain on sale did contribute to the overall increase in production revenue in Q3. But again, that was not enough to offset the increase in costs, which led to a net loss on production profitability in Q3. So moving over to costs, here we're looking at cost to originate on a dollars per loan basis. So here we're looking at all expenses only related to originations, dividing that by closed loans over the period. In Q3, we did see an increase in cost to originate. So that was up $725 per loan, or about 6% from Q2 on average, bringing that cost to originate up to $12,142 per loan. You'll notice that we did see actually a pretty significant decline in Q2, but with the increase in Q3, costs are now in line with what we were seeing in this quarter of last year. And costs are certainly up on a per loan basis due to the decrease in production over the quarter, especially when you consider that costs overall were up slightly. So costs were up across all departments. And then I'll just point out, we did see the overall headcount remained relatively flat in Q3. Down marginally in a couple departments, but overall flat. But personnel expenses on a per loan basis were up overall. And you can see it was up across departments. So sales, both producing and non, was up about 4%. Fulfillment roles, that cost per loan was up 2%, and back office up 6%. And then operations and overhead expenses, again, this is where the largest change in cost per loan occurred in Q3. That was up about 12%. And then specifically the increase there was in technology-related expenses and professional fees. So lastly, I'll go ahead and dive into loans, average loans per FTE. So here we're looking at average loans closed per employee or FTE each month. So we're taking total closed loans over the quarter and dividing that by total headcount and then converting that to a monthly average. So again, total headcount was flat or down slightly across departments. Overall personnel was only down about 1% on average compared to Q2. So really not a lot of change when we look in aggregate. And then again, when we look at average closed loans per individual, we didn't see a lot of change. Loans closed per FTE in Q3 was only down 2% from the prior quarter. So again, slight decreases in total headcount and slight decreases in loans closed per employee. But when we break that out by department, we do see some wider variances. So total sales personnel, again, was nearly flat in Q3, but loans closed per sales FTE was up 24%. And then when we look at fulfillment and back office, we did see a very slight decrease in total headcount there. And both departments also saw a slight decrease in loans closed per FTE. So again, in Q3, we saw similar trends that we saw earlier this year and in 2022. And then in Q4, we've continued to see volatility in rates and a decline in production compared to Q3. But as Nathan mentioned at the beginning, in recent weeks, we have seen some improvements. Freddie Mac's most recent weekly rate survey was just released today. It showed another, albeit smaller, decrease in rates, but we continue to drop down from highs seen in late October. So there really is some hope that this trajectory continues and that we see an overall decrease in the coming year. So thanks everybody for your time. I'll go ahead and pass it over to Seth Sprague.
Thanks, Molly, and that data is always so valuable for folks, and it is interesting to see the trending that while Q3 2023 was still a loss, it was less of a loss than it was a year ago. It really speaks to the fact that people have done a lot to cut expenses and try to control costs. Okay, so my little topic today is servicing friend or foe, because I couldn't come up with a holiday theme that worked. So if we go to the next slide, let's talk a little bit about servicing. And as Molly, but before we get there, we got our second poll question. So remember, you got to answer all 4 to get your CPE credit. So the question here is, will you be attending the MBA IMB in New Orleans in January 2024? Yes, no, still deciding, leaning towards yes, still leaning towards no. We like to throw these in once in a while just to try to get a gauge as to how many of our clients are going to be there. We came off the accounting and finance conference a couple of weeks ago, and it was, the attendance was noticeably lower this year. Where I would say at annual, I thought it was actually a very good performance. A lot of folks at annual. So once we get to critical mass, remember you got to answer all 4 of these to get your CPE credits. And Felicia will let us know when we get close to the right amount so we can move on.
Yes, we have about 10 seconds left to keep this poll open, and we do have lower than on our first question. So please, everyone,
answer all 4. Get your CPEs. It's the end of the year.
Okay, I'm going to close it now and share the responses.
And so a lot of folks not attending IMB in New Orleans, and I think our anecdotal evidence would support that as well. We are anticipating that IMB this year is going to be the attendance will be off as expected, given the profitability. So hopefully we'll see folks there. If you are going to be there, reach out. We will set up time to sit down. So back to the presentation. So servicing friend or foe. And I would like to say I'd really planned ahead and knew that rates would be dropping over the last 3 weeks like they did, but I really have no idea what rates are going to do much. I'm not an expert in that. But if we go to the next slide, Molly, it's certainly a friend for now. This is from the MBA, and this echoes the data that Molly talked about. When Molly was presenting the Richie May select and analyze data, she talked about the fact that for companies that were more profitable, they had servicing. And that's what the MBA data suggests as well. So very consistent with the MBA numbers and the Richie May data. About 50% of the companies were profitable. But if you didn't have servicing, your odds of being profitable probably dropped to around 1 in 3, maybe 30% chance. So servicing has been a huge positive contributor for the first 3 quarters of 2023. So Molly, let's go to the next slide. And as we talk about where it has helped, we've seen kind of a continual drag up of values in 2023. This is banks, and I presented similar slides at Accounting and Finance Conference. I want to highlight a couple of things here. Banks are kind of executing a lot of excess servicing trades, so their value may not be moving up as much as you would expect because they've changed their servicing fee. But values have consistently sort of risen in 2023, and if you're under fair value accounting, that's positive to the P&L. I'll save my snarky comments towards the end of the slides here. Let's go to the next slide. As we think about that value change percentage, again, it shows sort of a negative in Q1 2023. Some of that is the impact of excess servicing transactions. But servicing has been a positive contributor for this year, though its effect has really been muted in 2023 compared to 2022 or even 2020, because we're really getting to the sort of terminal values here. There's only so much value that can be ascribed to the servicing cash flows. It's a net present value calculation. So there's not a lot of juice left there. And with the recent move in rates, values are certainly not going to be higher in Q4. So Molly, if you go to the next slide, as we think about servicing potentially being a foe to you, and I'll steal the punchline as Molly flips the next slide, but one of the key factors in your MSR valuations these days is the value being ascribed to your escrow earnings or your float. And this is often tied to something around the 5-year treasury rate. Well, this rate in November has dropped about 65 basis points. So your escrows have become less valuable in the fourth quarter, which means your MSR values will be lower in the fourth quarter. And these slides are actually done a couple weeks ago before we actually saw this rate movement. So they're kind of timely in the fact that we're at a different point in rates than we were even 2 or 3 weeks ago. So if you're getting a November 30th valuation, or you're going to get one at year end, you should at this point expect values will be lower merely due to the fact that the escrow earnings rate is lower. Prepayment speeds really haven't probably picked up, but you're seeing that drop in value. If we go to the next slide, one other area to potentially think about is the future of the Fed funds. This is a Fed funds rate forecast. Like, you can find any article you want about how many cuts will be next year. Fed fund future shows 2 rate cuts. MBA thinks there's 3 rate cuts. Other people think there's 6 rate cuts. And I think the general theme is rates are going to get cut next year, just not sure when. And the timing of, are they in 2024, 2025, or 2026, I think is somewhat in question. But Fed rate cuts will also potentially affect that 5-year swap rate, 5-year treasury rate, which will lower your escrow earnings rate assumption as well. Let's go to the next slide. Ginnie Mae prepayments. As we sit here with ultra low prepayment speeds and flip to the next slide, Molly, and sort of delinquencies on the FHA front kind of increasing, one of the areas where servicing can be a foe to you, particularly in the fourth quarter or first quarter next year, is that there may not be, if you hold Ginnie Mae servicing, which is schedule, you may not have enough float in those paid in fulls to cover the advance requirements. So you may be out of pocket on advances. So just something to be aware of on your FHAs. And on numerous calls this year, we have talked about this, but remember, year end, December, the last business day in December is the 29th, meaning that you're not going to be processing payments on the 30th or the 31st. So you could be in a situation at year end where you have elevated delinquencies in your servicing portfolio merely due to what I call the calendar impact, right? You have 2 less processing days at the end of the year. Something to be aware of as you kind of roll into year end. Next slide. One other area that I always want to just call, and this is some FHA data on delinquencies you could just see on those FICOs. If you're keeping those 620 to 659 FICOs in total across the entire FHA data set, those are 15.99% delinquent. I would round that up to 16%, right? Those are all loans you'll be making advances on. So just be aware of where you are, particularly if you have Ginnie Mae servicing and your concentration of FHA servicing. And on the next slide, we've got another little just nugget to be aware of in your servicing portfolio. And this is from Mr. Cooper's earnings release. They have really strong disclosures, in my opinion, but the structural element of prepayment speeds, just due to payments, is running around a 4% CPR, meaning that just borrowers making payments is reducing that unpaid principal balance, which is in reducing your servicing fee, which means as you project forward, make sure that you're accurately accounting for the decay, natural decay of the unpaid principal balance in your servicing fees for 2024. As we go to the next slide, that's really important when you think about the 2020 and 21 production, which is now getting more seasoned. that decay elements can continue to increase over time. And a couple of just more things to continue to monitor. Just remember Basel III Endgame, which I know we talked about last time. Those capital rules may have an impact on correspondent channel. We've seen one large bank get out of the wholesale channel in the last 14 days. Delinquencies we've talked about. MSR fair values may exceed bid levels, and it's kind of getting late in the year to actually execute MSR trades. So make sure you've got that fair value. Make sure that you understand your fair value is probably going to be lower at year end than it was in September or October. Timing of escrow shortages, work with your servicing operations and your sub-servicers to make sure that you're getting good reporting around when they're going to be doing those escrow analyses, so that you can make sure you understand the potential shortfalls. And just be always careful about those hidden pockets of delinquencies that can be masked within a servicing portfolio. It could be geography, it could be vintage, it could be FICOs. Just make sure you're aware of where your delinquencies potentially reside in your servicing portfolio. I think we've got one more poll question before I turn it over to Mignon. So my servicing strategy for 2024 is best explained as I plan to retain a greater amount of servicing than I did in 2023. I plan to retain the same, plan to retain less, or I don't retain, but I'm thinking about it for 2024, or the dreaded no, I don't retain servicing at all question. And remember, you have to answer all four of these questions. I'm so good with numbers. 4 of these poll questions in order to earn your CPE credits. And once we get results, we will turn it over to Mignon to talk about Fannie Mae and some MORA on it. So Felicia, how we doing?
We have about 70% in and 15
Oh, we can do
seconds
better than
left.
that.
Yeah, that's a little lower. So we want to make sure that people have a chance to get this answer in here. We'd love to give you CPE. So
Remember,
about 5 more seconds,
5 more
everyone.
seconds.
Okay, closing now and sharing.
And, not surprising. I would say that, plan to retain about the same percentage. I think that could change based on where rates go. Certainly, we've talked about rates are down a little bit. Maybe we get a little bit more production. 12% we're going to retain smaller, 9% would retain less. And I know some folks on the call just don't retain servicing at all. So probably what we expected to see in these results. Nothing too shocking here. So with that, I will turn it over to Mignon, who will cover Fannie Mae MORA audits.
All right, thanks, Seth. And thanks everyone for joining us today. My name is Mignon Davis, and I'm a director of compliance services here at Ritchie Mae, and one of our teams does internal audits. So that's what we're going to be talking about today with regard to Fannie Mae. And I'm sure that this is not your favorite topic. Audits are never fun, right? And going through a Fannie Mae MORA is probably not on your wish list for Christmas this year. But I think this topic will be beneficial, and our goal here today is to provide you with some good information to help you stay on track with Fannie Mae requirements. So we're going to talk about some of those requirements with regard to internal audit, and also with regard to quality control specifically. So if you have not undergone an internal or a Fannie Mae MORA in the past like 12 to 18 months, gear up for it, get ready, because as Nathan alluded to in the beginning, Fannie Mae is very actively conducting these MORA reviews on banks and IMBs that are approved with Fannie Mae. So we've heard from many clients that we engaged with this year as a result of Fannie Mae MORAs, clients who had been approved with Fannie Mae for upwards of 20 years and had never undergone a Fannie Mae MORA until this year. So it's definitely something that is happening to everyone right now. So we want to help you be prepared for that. So when Fannie Mae comes in and does their MORA in the beginning with regard to internal audit, they're going to ask you for several different things, which I have listed out here. They're going to want to see internal audit policy and procedures. They're going to want to see a current year's risk assessment over the manufacturing process, loan manufacturing, so all operational areas of originations. And they're going to ask for a current year's audit schedule or plan. So also with that, you're going to have to be prepared to provide them with internal audit reports that have been completed in the past 12 months. And you'll want to show that you have a tracking system to track findings that are identified in those internal audits, that you're tracking those and monitoring them for corrective actions, making sure that those corrective action plans are implemented. And we'll talk about that a little bit more in depth here in a few minutes. They're also going to ask you for an org chart reflecting the independence of the internal audit department. So internal audit needs to have its own reporting line. It can't share reporting lines with operations or any auditable areas. The other thing that they're going to want to see is an independent QC audit within the past 12 months. They require it to be done annually. And a little information on this is that you're not going to find this requirement in the Fannie Mae selling guide. For whatever reason, they have not put it in there. However, they will give you a finding for not having an independent audit over the QC function. They do require it annually. Fannie Mae has put out a self-assessment QC checklist, and the requirement is listed in that checklist. And Fannie Mae has also put out a pamphlet, a Quality Insider pamphlet called Strengthening Your QC Program, and the requirement is listed in there, but it is not yet in the selling guide. So just be aware of that, something that, a conversation that we have often with clients on that front. So again, if you don't have internal audit right now, all of those things that we just talked about are going to be findings on your MORA, because you're not going to have, policies for internal audit to provide them with. You're not going to have internal audit reports from the past 12 months, right? You're not going to have a risk assessment or an audit plan. So really taking a step back, if you don't have an internal audit function right now, the first thing you really need to do is decide whether you have the resources internally already that possess the skill set needed to develop and deploy the internal audit function. Deciding that, do you have those resources that with that skill set? Do they have capacity? Do they have availability to be able to do that? Or are you going to need to hire someone? Another option is outsourcing it to a company like Ritchie May. We have about 90 different clients that we provide internal audit services for, so you can outsource that function to us. And part of this decision-making process is, of course, doing a cost-benefit analysis. You're going to want to look at the costs to hire or dedicate staff to that function versus outsourcing it. And a lot of times we find that it's a lot more cost effective to outsource it. So, do that cost comparison and make that decision there. And if you decide to outsource it, then of course that's an easy solution. You just give us a call and we'll help you out with that. All right, so moving on to the next slide. The first thing that you're going to want to do with regard to setting up this internal audit function is conduct a risk assessment. So Fannie Mae requires an internal audit plan and schedule that's risk-based. So you can't really do that without a risk assessment. So that risk assessment process really goes through and evaluates and categorizes the risks in each department, and takes into consideration too the mitigating controls that you have in place. And through that review, we're going to figure out what the residual risk is and rate each of those process areas. Next, from that, we're going to develop that audit schedule or plan. And the reason that comes next is, again, because that plan has to be based on the risk rankings for each process area. And doing that really ensures that higher risk areas are going to be audited more frequently, such as QC. So because Fannie Mae considers the QC function to be high risk, that's automatically going to, tick that up and be on our schedule every year. So it really elevates that risk rankings, because we want to align with what Fannie Mae considers to be high risk. And here at Ritchie May, we've developed a process with our clients to really review this audit schedule throughout the year. It's required to be updated annually, but throughout the year, you're going to want to adjust your schedule and incorporate any emerging risks in operational areas, which could be process changes, management changes, could be regulatory changes in certain functional areas. So you want to definitely make sure that that you're reviewing your audit schedule throughout the year. You know, it's really a living and breathing document that is going to change all the time. So it's not set in stone, but you do have to, you know, at least have it. And then really the communication and collaboration with clients is key. And we here at Ritchie May have a framework for interacting with our clients. Our internal audit team has very open communication with our clients with regard to the audit schedule, but also throughout the audit process. You know, our goal is to help our clients build a strong control environment. So that's really where the value add comes into play as the results from having this internal audit function. Okay, and we can go on to the next slide here. So I've talked about this a little bit already, but I just want to expand a little bit more. So you're going to want to document internal audit findings and report those findings to management, of course. Track those findings and have the responsible business units complete a root cause analysis on each finding and develop an action plan when necessary. Some findings are one-offs and it's not necessary to have an action plan. Some action plans may be very simple, like additional training was needed for a particular employee or a particular department. So you want to track that action plan and make sure that that training was completed and what date was it completed on, right? Keep that documentation. Some findings may be systemic and they're going to require maybe system changes or process changes. So it may include multiple different responsible parties or business units. So tracking those action plans through to completion is very important. And it's also important to hold the business lines accountable for making those changes, you know, and that's part of that monitoring and tracking process. And you can even use that as a way to evaluate departments' performance as well. All right, and moving on to the next slide here, we're going to dive a little deeper into QC now because we've kind of hit all the internal audit requirements pretty hard. But so going back to the Fannie Mae requirement of having an annual QC audit, which is not in their selling guide, but is published in other things, and they will give you a finding for it. So going back to that, I wanted to also mention that the results in your final report annually of that internal audit over the QC process, it is required to have a statement in that report that says that the QC audit was not influenced by other business units or that there was no bias in that. So make sure that that statement is listed in there. And I wanted to also mention too that this is really a high risk area with regard to Fannie Mae because a lot of problems can be identified and mitigated during the QC process. You know, the QC process, especially pre-funding, right? You're looking at the loan manufacturing process, and you have that ability to really make changes and mitigate problem areas. And I think that's why Fannie Mae really hits this hard. When they come in and do a MORA over your operations, they really look at QC very, very closely. So you really want to make sure that that your QC function is performing properly and you've got a good, strong process. All right, now I have put together a list, and we can go on to the next slide. I put together a list of, I was going to do top 10 findings. It wound up being 11. So, but I wanted to put together this list of findings, and I have a much longer list. I could probably talk about this all day, right? We don't have enough time for that. But this list, I think, will hopefully help you. These are some findings that we have seen, identified in our own audits, or heard from new clients that have engaged with us as a result of a Fannie Mae MORA, you know, and they tell us kind of some of the findings that they've had in their MORA. And so I kind of put together a little list list here, and these are all with regards to or related to the QC function. So first one is not selecting a discretionary sample. Definitely need to make sure you're doing that monthly. Pre-funding and post-closing QC reports need to have defect trending information in every monthly report. Not having evidence of the verification of occupancy, that needs to be in the file. No evidence of your attempts to re-verify required assets and income, employment, that sort of thing. So keep those attempts documented. Also, and this is an interesting one that we've heard of this year, is that the QC department didn't always include or maintain documentation of the reconciliation between the 4506C transcript and the income documentation in the loan file. So even if the tax transcripts do not need to be ordered during the underwriting process, if that loan is selected for QC, it then needs to be ordered. That 4506C needs to be ordered, and every single loan that is QC'd needs to have that 4506C transcript in the file and documentation of this reconciliation between the transcript and the income documentation. Also, not reviewing a minimum of 10% of the vendor's work. If you use a QC vendor, you've got to do that check the checker, 10% review of their work. So make sure you're doing that, and not having in your QC plan, again, if you use a vendor, if the vendor has any fees related to or associated with the re-verifications, your QC plan actually has to state in there that you're going to reimburse them for it and lay out the process for it. We have seen findings on that. I know it seems like a very minor thing, but we have seen findings on that. That is required in the QC plan. Also, we had a client tell us that prior to engaging with us, their Fannie Mae MORA had identified that they were removing broker loans from their sample selection, or before they made their sample selection. So they were taking those loans out and then only selecting their retail loans. So of course that, that was a finding. So you need to make that sample selection of the whole book of business. Don't remove loans. Okay, it's got to be everything. And also keep evidence in the file of the collateral underwriter that was run on the loan. Also, make sure that you're maintaining evidence to support a limited review of condo projects. Fannie Mae does look pretty closely at condos. So make sure that you're doing those reviews, and your QC function is the perfect area to identify any issues there. So I'm going to go ahead and wrap this section up, but just let me know. Please feel free to reach out. I have lots of information about Fannie Mae findings and other areas. I would be happy to share information with you and talk to you about how we can help. We've helped several clients prepare for MORAs with our MORA readiness program that we have. Also, continued internal audit services, as you do that ongoing, that's going to always keep you ready for your next Fannie Mae MORA. So that's our goal. So I'm going to move on to the next poll question that we have right now, and that is, what best describes your current internal audit function? You perform it in-house, or it's 100% outsourced, or maybe some combination of the two. Some is internal and some is outsourced. And we'll give you just a couple minutes here.
So we have about 67% of you in at this point. I'm going to be closing this poll in about 15 seconds. So I want to make sure that everyone has a chance to get their CPE. Please vote at this time. We have 75% of you.
Okay.
So again, closing in about 10 seconds. I want to make sure that everyone who wants it can get it.
Yeah, get it in there.
That is it. I will share the results.
Okay. All right. It looks like, okay, Yeah, majority have it kind of somewhat outsourced and some internal. So that's good to have a little combination there. Sometimes you need to outsource, certain audits that maybe you don't have expertise in that certain area. So you outsource just a few audits, and we can help with that as well. And yeah, it looks good. It looks like a lot of you at least have a function, so that's good. You're on the right path. All right, and I'll go ahead and turn it back over to Seth for questions and answers.
Great. We just have a few minutes for Q&A, and we want to be cognizant of everyone's time and then the top of the hour. But a couple questions for you, Mignon, and one of these is full disclosure from me, but what does even MORA stand for? And is it an annual or is it a random event that Fannie sort of picks you for one of these wonderful things?
Yeah, it's pretty random. Although I have talked to some clients that say that they're on a pretty good regular cadence with Fannie Mae, and they seem to, have a flow of doing it about every 2 years. But again, I've had several conversations with clients that have had their Fannie Mae ticket for 20 years and never had a MORA. So I think it really depends. I think it's very random, and it stands for, and I always have to Google it. So I knew you were going to ask that. I just Googled it. So it's a mortgage origination risk assessment. That's what MORA stands for, mortgage origination risk assessment. Now on the servicing side, if you have servicing in-house, when Fannie Mae comes in and does an audit over your servicing, it's called a STAR review, which is a servicer total achievement and rewards is what that stands for. And internal audit is also required over servicing if you service in-house too. But of course, today's focus was on originations.
And I see people advertising they get this STAR rating, but do they advertise they get a MORA rating or not really?
I haven't ever seen that. Right. Yeah.
I think that's it for our questions. We obviously want to thank Mignon and Molly for all that great information. More importantly, we want to thank all our clients. We realize 2023 has been a challenging year. We're here to help. There's a lot of resources across the Ritchie Mae firm to help you stay profitable, return to profitable, whether it's the data, whether it's the internal audit side, whether it's just keeping those risks down that Mignon can help. We're here to help. We really do appreciate your business, and this is our last one for the year. So we'd really like just to wish everyone a very early but happy holidays, happy, safe holidays. If you're traveling, safe travels, happy, healthy 2024. We look forward to being your business partners in 2024 and hopefully returning 99.9% of the industry to profitability. So again, thank you for your time. Thank you to our speakers. We appreciate the business. We realize it's been a challenging year, and we're here to help. So please reach out to info@ritchiemay.com if we can help in any way. And again, happy holidays, safe travel, and we'll chat with you all in 2024.
Thanks, everyone.